Good evening, everyone. This is the St. Thomas of Villanova Anti-Racism Committee, and welcome tonight. We're here for parishioner Dave McCarraher's presentation today, and welcome you all here. I think we should all be on mute while Dave is having his presentation, and then he's going to have questions and answers after his presentation. So similar format to what we've done with other parishioners presenting. So thanks for being here, and I'm going to turn it over to Dave.
Okay, good evening. Good to have you all with us. I have a short prayer to begin with. Let's pray. God of justice, in your wisdom, you create all people in your image without exception. For your goodness, open our eyes to see the dignity, beauty, and worth of every human being. Open our minds to understand that all your children are brothers and sisters in the same human family. Open our hearts to repent of racist attitudes, behaviors, and speech which demean others. Open our ears to hear the cries of those wounded by racial discrimination and their passionate appeals for change. Strengthen our resolve to make amends for past injustices and to right the wrongs of history. And fill us with courage that we might seek to heal wounds, build bridges, forgive and be forgiven, and establish peace and equality for all of all in our communities. In Jesus' name we pray. Okay. It just happened. I think I lost you. Let's try this again. Okay. Let's see here.
Here it comes.
Okay, let's see.
And then you got to do slideshow towards the center in the red.
I am getting my anchor. Let's see.
Up here. Oh, maybe I can click it for you. No. But right after animations, you have transitions and animations, and then slideshow over towards the middle here in the red.
Up top?
Yes.
Yeah. It's hidden by some reason for that. Oh, wait a minute. There we go. Okay, there we go. Slideshow. And then, from the beginning.
Yes.
And let's see. Okay. There we go. Can you see it?
Yes.
Okay, good. This was born out of my experience. I worked for the Federal Housing Administration and affordable housing and mortgage finance for a number of years, and we came across almost every possible situation of inequity, discrimination, pain, and people losing out on transactions and mortgages. So I wanted to talk tonight about two concepts. One is disparate impact, and the other one is appraisal inequity. So I'm just starting with some definitions with racism, racial exclusion. I'm going to say a little bit about predatory lending, that how that's worked into things over the years, and still even contributed to our recession, a great recession back in the 2007, 2008, and still exists today in certain forms. Redlining, again, is exclusion of certain geographic areas where mortgage credit is either on not the best terms, or people are excluded from equitable financing. And then reverse redlining is, again, it's where you put unfair terms into those same communities. So you're putting the way it's mentioned, a bad or poor mortgage product, where they carries higher interest rates, higher closing costs, and fees, where folks who are out of those areas don't have to pay all those extra charges. And there's even surveys just recently that have said that people of color in certain areas pay percentage more of closing costs even than people, white individuals or non-minority communities. So it's still there. It's ever present, and it will be with us. Well, I have a quote here from Kianga Miyamata Taylor, who's a Princeton University professor and has done a couple presentations for the Federal Reserve Bank, and this bears on something that Jerry Burton said in one of our previous meetings, and I'll quote: "A truly equitable market cannot be built upon the kind of corrupted and fragile foundation that has been created by decades of intentional discriminatory disinvestment." So she's saying the system we have now, the structure we have, can't give us an equitable system. Yet what we have is what we have, and there are attempts being made different ways to just move forward. So we have to really move with what we have. But her frustration shows in her statement that until you do something else, and there are forces present that want to keep our old system. And so I'm just going to give you a little bit of information. Again, this is financial information. It's two areas. One is real estate finance, which is really mortgages. That's the area where I worked most of my time. And then the other one is the appraisals. And when it comes to mortgage credit, you're doing credit and appraisal reviews, and seeing a little bit of everything, even on the loss mitigation and the people trying to help people save homes that because of circumstances, especially back in 2008, 2009. And Father Greg Boyle from the Jesuits says, when it comes to racism, it's in our marrow. You can't get rid of it. It's ingrained, but at the same time, you have to be able to learn how to move forward. Okay. Again, you've probably heard this a number of times. In the last, I think, 3 weeks, the Inquirer has published 3 different articles on racism or inequities with respect to refinances in the minority communities. The interest rates were very low. The people in minority communities were not, even though they were good credit risk and had the ability to do a refinance down to a lower rate, they weren't marketed. They were ignored. And I'll give you a little bit of explanation about that. So research has shown that the average white family has 8 times more wealth because of this wealth building mechanism of home ownership. And this evening serves as a reminder of the disparities that we have and need to keep working on. I did mention the Consumer Finance Protection Bureau came into being about almost 10 years ago. And this has really shined a spotlight on a lot of inequities, not only in mortgage finance, but in real estate, but also in consumer finance. But it does take in real estate financing and mortgages. So it's an uncomfortable spotlight to be in, but at the same time, it's something that has to be shown so that we have a way to deal with something. We can see it actually. Now, so I'm going to talk a little bit about individual situations, but more of it's an overarching. How can one mortgage in one particular community be inequitable? How do you even know it's not the best for somebody? And so a couple of things I'm going to talk about is disparate financing or disparate treatment. And then it's really systemic racism to various degrees in the business fabric of our community. And there's a lot of forces, even today, that are pushing back against this. And I'll give you some of the story down the road. Okay. And one thing, I'm having trouble seeing the very bottom of my slides. Oops. not sure they had to get rid of that bar down there. Maybe bring it up to the top. I don't know.
Oh, yeah, the bar of like the gallery of all of
Okay,
us.
there you go. Okay, I
Yeah, you
got it.
can drag it anywhere you want to on your
There you go.
screen.
Perfect. Okay, thank you. Now I can do that. Okay. Okay, so let me make sure so how disparate treatment occurs is in buying a home. Mortgage lenders, most of whom are non-banks. So if we think of typical mortgage sources as banks, but most of those mortgage sources are basically the individual, maybe who's owns a small mortgage operation, and then takes applications, packages those loans, and sells them to a aggregator of mortgages, whether it be a bank or maybe an investment house, any number of those things. And I'm going to talk a little bit about yield spread premium because if you get a mortgage and you say, okay, well, what's the rate and how much what's my lowest possible rate, and then anything in between the base rate and the rate that the borrower's offered can be profit, but it still has to be equitable. You can't charge somebody more. And this is what's happening in minority communities. They found that they were overcharged versus non-minority communities. So it's something that's been exposed, and more data we have, the easier it is to find, but there's still a lot of pushback. So they can charge more as long as they charge everybody the same rate, and it's called yield spread or premium pricing, and the difference between the wholesale rate and the retail rate, basically. Just like when you buy a car, there's a wholesale price and a retail price. The idea is that when you buy a car, again, maybe the Consumer Finance Protection Bureau finds out that people of color are getting charged more and with the same type of credit characteristics. It's even easier to spot those disparities in the mortgage market because everything goes into a system and it's codified. And if you want to pull the data, it's there. There's even a system now that FHA has had in effect probably for 20 years. They told the mortgage industry they didn't have enough transparency. So they said to the mortgage industry, you put something out and we'll work with you on it. So for about 20 years now, there's a system called Neighborhood Watch. And there's a public view that actually allows the anybody looking to see where the mortgage performance, where the defaults are, where they aren't. And give an example. This system allows you to drill down to a zip code. A zip code is a lot smaller than the census tract, so you can see zip codes in Philadelphia that may be larger, 80% minority, and you see certain lenders or even buyers of those mortgages not buying those mortgages, and it's been discovered many times, and they've been singled out for it. Why are you not putting mortgage interest or mortgage credit into those particular communities? So let's move on though. Down the bottom, I wanted to give you, I guess, two points I wanted to really talk about is this disparate impact and appraisal inequity. And I give you a definition of disparate impact because that's a big battle these days. And even though it's been made into regulation, it's been unregulated or deregulated. So all borrowers have to be treated equally. And otherwise it presents a disparate impact to certain borrowers. Many times they're minority borrowers in defined census traction zip codes. That's really one of the concepts I want to talk about. And then appraisal inequity, and I'll give you an example about that. And this is something that's further below the radar. And I think the more we shine the spotlight on these practices, the more institutions and businesses and business entities are made aware even of their own activities in their own organizations. So again, mortgage lenders, I think we covered this, the yield spread premium, if it's different pricing, but if you offer somebody, a person of color, a higher price than somebody who isn't of color, then if there's an equity that comes, and you say, okay, how can you find out with just one particular transaction? How do you know? But looking at a number of transactions and pulling the data, and I'll go a little bit more into that. So, as an example, interest rate, right? This is almost current, basically. Owed by a lender to a minority borrower is 3.75, but the market is 3.5. And so I cross town, I can give folks 3.5, the best rate possible. That because I perceive more risk in a minority community, and it's perceived, it's not, it's biased, and they're charged a higher rate. And again, it's geography and race are the two primary indicators. And again, it's I say, well, that community has a lot more mortgage defaults or mortgage latenesses, and I'm going to assume that my borrower will probably be one of those, and I'll put mortgage credit into that particular census tract. But the idea is that borrower is being underwritten on their parameters, their good credit, their savings, their employment. There is no implied disparity or impact for the particular borrower. If they are a good risk, they're a good risk. And that's again, it's perception. So yield spread premiums are legal, though, and they can be added fees for brokers and lenders get them, and if they turn them back to the borrower by subsidizing some of their closing costs, that's permissible. That's called premium pricing or yield spread premium pricing. For instance, a no-cost mortgage. You come at a higher interest rate, but then the cost or fees are paid by the lender. That happens. You cover so much of my fees. And with FHA, we were talking 3% down. So we were talking people who needed to get into homes, who could afford homes, but again didn't have the cash down to do it. So they could build some equity in their homes. Now I mentioned predatory lending, and predatory lending is what caused our big mortgage crash back in 2007, 2008, and it's called subprime. Had a number of names. Now that the accepted name in the industry from my friends who are still in the mortgage industry tell me the new acceptable word is non-prime. It's still a loan that still comes with onerous terms or creates more risk. And again, it's a loan that given the individuals with poor credit scores who probably wouldn't qualify for conventional or even FHA mortgage because their credit is not where it needs to be. Now, there are most of the lenders out there really do good work, and they have their hearts in a good place. It's just a couple that really can cause the problems. There are lenders, a good loan officer will see if they have somebody who wants to buy a home, they know they don't have the credit score to buy the home where they meets the requirements. They'll work with that borrower, and even housing counsel agencies, HUD-approved agencies are out there who work with borrowers to, okay, where do you need to be? You need to have some savings. You need to have, we'll counsel you on how to bring your credit scores up. And that's done every day. But the subprime mortgages, they take what is out there, what the borrower comes to them with and say, well, we'll make it work no matter what, because somebody's willing to buy that mortgage with more risk. There's all types of mortgages, interest rate only, fixed rate, adjustables. And I think I have an example of an adjustable. But the loans still come with a lot of risk because of the potential for default, where the borrower does not qualify for a regular mortgage, but somebody's willing to overlook the parameters. Now, new non-prime mortgages have restrictions, and they have to be underwritten, but at the same time, there are still ways to get around it, depending on the entity buying those mortgages. And mortgage pools are in $10 million lots, and they go to maybe the Fannie Mae, Federal National Mortgage Association, the Federal Home Loan Bank. It depends who's buying them, but also private equity corporations who can shoulder more risk. We're willing to buy a set of mortgages that are not the best terms to begin with. So It turns out that a lot of folks were burned with the predatory lending back probably 15 years, almost 15 years ago now. But again, it was an example of structural racism and practice, because most of the people, a lot of the people, well, I don't have the percentage or statistics, but it were people of color who really lost their homes and they were struggling. And then when a person loses a home, no matter who they are, it takes years to rebuild their credit. So if somebody has a bad mortgage at the beginning, it's more of a problem. So almost 75% of all subprimes, now is known as non-primes, are made by mortgage brokers with yield spread premiums, and we're notorious for targeting communities of color and also low-income communities. It's blatant predatory activity that takes advantage of a borrower, and it's a cycle that keeps on going. It leads the borrower to going to non-prime mortgage source and with unfair terms, and the borrower, the homeowner, agrees to more risky terms because they want that house now. We have to have this. And I give an example. We had, and with FHA, we're talking to people who, mortgage companies are doing the loans, but when the loan doesn't get approved, talk to FHA. So they would come into the office and say, "Why aren't you approving my loan?" Well, it's done by the mortgage company. They have to meet the standards. And they would say, well, my credit score isn't the best. I don't have any savings, but they're saying they'll approve a mortgage on the other side of town. So and we had people who would say goodbye. This person, lender B, was going to give me a mortgage, and I got my home. And then a couple of years down the road, because it's an adjustable interest rate, an adjustable rate can start. They can go up to 5% over the beginning rate. So if you start at 2.5%, you're going to be at 7.5%, and possibly the first 5 years. So it can really accelerate. And then if you went in with bad terms, nobody's going to refinance it to a lower rate. You're stuck with that rate. So and then the market right now, we're still around 4%. The rates are going up at 4.25%. But somebody has an adjustable rate mortgage that they got a couple of years ago on bad terms, that could be about 5% right now, going to 6 or 7%. So that's the idea with the predatory activity. So again, it's the more unfavorable or slanted terms of a mortgage, especially on a buyer with limited savings, the more fragile the loan. And again, they say many families are just one particular crunch of a bill away from a mortgage default or a mortgage slowness, and it's proven statistically, if you have send somebody into a mortgage with $0 after they close that loan in savings, and a job that it's week to week, and they have good income, but at the same time that they can't handle, they can't make any savings to set aside. They have a mortgage slowness, and not to mention recovering from unsatisfactory credit from late payments on bills. That's another big problem. The huge disadvantage with non-primes is that they evade disparate impact reviews due to the private sources of funding. So there's a little bit more of a cloud that's out there, and you can't see it. Some of the data is hidden because they're getting mortgages from unconventional sources. They're getting mortgages. So it's a way to avoid being analyzed for abusive practices. Again, the disparate impact rule, all borrowers have to be treated equally. Otherwise, it's a disparate impact. And the way we found that out is that the people with getting a particular mortgage, say in a particular period of time, say from March 21st to the 25th, and they're saying that a particular lender or particular lenders are giving certain rates, and sorry about that, they're quoting certain rates in particular geographic areas, and they have to be the same. And if there's disparities, they have to be eliminated, and protected classes have to be protected, and there are offenders and those who do offend are called to the task and are presented with the data, and they're asked to provide information as to why they're charging different rates and doing different pricing. And just this is from experience. I won't name names, but very large mortgage lenders were in Philadelphia and seem to be avoiding particular zip codes with large minorities, but yet they're doing business all around those zip codes. And we've ever called the task, well, we've done 50 mortgages in this particular zip code, and our numbers are slow payments are increasing, so we're going to stop lending in that area. Well, the idea is to do it by loan, not particular, because you see a lot more risk being created. It's not supposed to be that way. So now when they look at these folks, there's a restorative process and there's punitive process that works with the lenders, and they say to them, if there is a way for you to make good and to work with these borrowers, there might be less a punitive effect on you, and the punitive effect is civil money penalties. And so the civil money penalties actually doesn't hit the press, but it is publicized. It's just not it's posted, but it's not publicized beyond that posting. It's the Federal Register. And we've had companies in Philadelphia that pay as much as $85 million in fines, and yet you see their advertised ads on the TV every day, and they've quietly paid those fines and keep on going. And so that's, but the idea is to work from a restorative, constructive remedy, so that there's a way to not to punish the mortgage company or the mortgage investor or the entity, but to keep them from doing it again and get them on the track to doing good business. Where all this is leading is there was a disparate impact rule that goes back to the early 90s, and that rule was published in the Federal Register, and it was renewed and re-strengthened in 2013. And this is the language from that particular rule. The first one is really the important one. I'll read it. It's a policy, even one that is neutral in its face, has a discriminatory effect when it actually or predictably results in disparate impact on a group of persons, or creates, increases, reinforces, or perpetuates segregated housing patterns because of race, color, religion, sex, handicap, familial status, or national origin. So that's why I talked about some of the things when I started with the earlier slides. This is really a hefty rule, and it's easier to spot now than it ever was before. It's something that is still happening, but now that there's more tools to go with it. And again, it's just basically census tracts and zip codes and looking at what's going on. It's to give you another sense of it. This particular rule in 2015, it was affirmed because of challenges. It was affirmed by the Supreme Court. So you figure, okay, it's been recognized. It's something that was tested and proven to be fair, and the Supreme Court even went ahead with it. Well, in 2019, HUD was ordered by the administration to reduce or weaken the disparate impact rule by increasing the burden of proof on those filing the complaints until the revised rule became effective. So just with a stroke of a pen, it was that particular rule was almost evisciated, basically. And it was a sad time, but that gives you a sense of the force at work to beat back some of the protections that are for minorities or for any type of discrimination. So the weekend rule became effective in 2020 through June 25th, 2021. The HUD secretary says, okay, I'm coming out with a new rule, in essence, lifting the onerous burden of proof on those filing complaints, taking that particular increased burden of proof away again. So it's basically restoring the effect of the 2013 rule. And it's so it gives you an idea that no matter if you think you have something and you put it together and you publish it and protect it, it's still there's still a way to push back on it, and there's forces at work that don't seem to go away, and there's so many challenges to go with it. Again, this slide may be a little bit out of place, but the adjustable rate mortgage again is it's out there. There can be in a good market. They're not used, but in a market with rising rates like we have now, you might see people coming in at 3.5% saying, okay, your rates will go up not more than 1% a year for the first 5 years. And folks can say, well, I guess I can earn more money next year and the year after that. And hopefully that it happens. You have good terms, or that you can refinance. I don't happen to have happened, but a couple of slides are out of whack or out of order. But I explained pretty much how that works. It could be the rates today is 3.5 to 4%. You could have a rate at 9% in 5 years. Okay, we did talk about that too, or stuff. Not sure how that happened. The second concept is appraisal inequity. And there's a whole number of things that go on with appraisers. And I have a nephew who's a real estate agent, the daughter-in-law is a real estate agent, and they complain all the time that they have appraisal management companies where the appraisal is ordered by a lender. We go into this. It's a way of washing your hands from responsibility sometimes. Well, we gave the mortgage, that appraisal to a particular company, and it's a more appraisal management company. They charge the borrower $500 for an appraisal, but the appraiser comes from 100 miles away, doesn't have the data set or the multiple list in front of them because they have to subscribe to it, and then gets paid half that price to do the appraisal on a property that they don't have all the data for. But the idea, maybe they'll push the value up to where they need it to be. And appraisers are basically self-employed individuals. And they say, well, if I don't, again, most appraisers do good work and not taking anything away from all the good people that really do diligent work and apply the standards that go along. But at the same time, if you want to dodge the system, you can pull an appraiser from outside the area who doesn't know the market and say, okay, well, I guess I have some latitude. But the idea is to pull an appraiser from the area. So my nephew says he gets an appraiser he doesn't know. Now there has to be a rotating roster. You can't get the same appraiser for every office or anything like that. But he checks to see whether the appraiser has access to the multiple list, so they can look at the comparable values. At the same time, they can look at they know the area, they know the market. They're also, I put up here automated appraisal valuation models, and again, they don't pick up all the nuances in a particular appraisal. And I think just recently, in the last 2 months, Federal National Mortgage Association, Fannie Mae, says now the appraiser who does the appraisal has to be the one that goes out to the house and does the measurements internally. They've found that houses had inflated square footage because they weren't actually physically doing it. They send somebody else out, like somebody in a training status or understudy, and this shows up a lot of times. So properties are improperly valued, and they can play around with it. And I'll have like an example I'll show you. So it's supposed to level of information on the appraisals, but they can use inappropriate and expired information. They're looking at valuation, and even though they're reviewing these loans, they're allowed to do three comparable values, but some offices want six values, and if they see a number of appraisals that are out of line, they'll ask for the last year's worth of their work and ask them to review it. Okay, let me see the slide here. So, according to the most recent census figures, Black home ownership in America is 46%, and it's the same level almost when Dr. King spoke in 1966. The white home ownership rate is roughly 74%. There's roughly recent figures. And then in 2017, home prices in Black majority neighborhoods across the country were priced $48,000 less on average than similar sized homes in comparable white neighborhoods. And how's that happen? Well, again, it's the appraisal, the implicit bias of an appraiser, and how they go about looking at a particular property. And we've witnessed viral news stories revealing how appraisers value Black and white homeowners differently. So it's a problem. Wow.
You went through the disparate impact and you went through the appraisal inequity. Are there,
Yes.
You might have a little bit more in your presentation after that, but are you able to summarize?
I can summarize. I had okay, I can talk through it. I see the slides here, but I don't see them there. I mean,
Yeah, but then we'll have time to ask questions too.
okay, well, just a couple things. There we go. Most appraisers will adhere to rules. Can you see me on the screen?
Yes.
Okay. Most appraisers adhere to rules and standards, and they try to appraisal management companies actually try to shed culpability a lot of times for appraisers. So bias, we're finding out, and then this is really something that's becoming more. This is the one that's further below the radar and more overt, and they're becoming more aware of what's going on. That finding out that most appraisers, well, less than 5% of appraisers are non-white, and so when you have appraisers who are a white appraiser going into a community of color, they have these biases that and whether it's ingrained or implicit, sometimes think redlining, and this is how some of the equities come into play. Now in Pennsylvania, appraisers discipline their fellow appraisers. The Department of State of Pennsylvania licenses the appraisers, but when it comes to a rotten egg, that rotten egg has to go to a board of their peers, and those peers are mostly white males and very few minorities, because that's how the culture is. It's been, real estate firms and people have learned from their parents or and they've been mentored, but it's mostly there's more women coming into the industry, but not many people of color. So the concern is, and this is something that we discovered at the FHA, if somebody wasn't doing appraisals to the standards, we would say you're not going to do FHA appraisals anymore. You're banned, and that's you can't do them, or for a year. It's usually 3 years to 5 years. But we send a letter to the state and said, here's evidence that this person is not doing fair values and good appraisals, and the state would say, thank you, that person's still going to do appraisals any other way, and we would say, well, are they flagged, or is there a probation? That's for us to say and not for you to know. That's the kind of feedback we would get. So we really don't know how much appraisal oversight there is in Pennsylvania, and what the discipline process is, and at the same time, good appraisers at times get squeezed out of work that the other appraisers are doing because they can give them the values, and information is you can ask for request information, but don't know if you're going to get it. I'll give you an example. On February 17th, I filed a right to know request with the Pennsylvania Department of State. Just give me information on people in the last 5 years, 2017 to 2021, not even racial, just say how many appraisers were removed from practicing or doing business as appraisers because of poor, shoddy work or not adhering to professional standards. A second question I asked were suspensions. Suspensions they were suspended, were they temporary or permanent? And then how many were reinstated after disciplinary actions? I asked for the number of non-minority and minority licensed residential real estate appraisers, in Pennsylvania. And I wanted to know the number of male and female licensed appraisers in Pennsylvania. They have a 10-day window to provide that information. And I got a letter back in 5 days saying, we're looking at it, we're going to pull it. And if you're willing to pay for it, I said, yeah, I'm willing to pay for it. How much you want to pay? I gave them a number. Okay, we're working on it. That was February 17th. I have yet to hear back from them after that, the 5-day letter. And because this is a hot potato, this is something that can cause problems in the industry. Now, just a couple more slides. In Denver, a Black family in another white neighborhood was looking to make renovations and sought an appraisal for a loan. This actual instances, which initially came in at $405,000. At first, the comparable properties were drawn from the separate Black majority community, not from their own community. During the second appraisal, the family removed indicators of race and received an appraisal based on comparisons from within their own neighborhood, which came in at $550,000, just because they removed their Blackness from their home. A second example, and I had a video for this one, so it's a shame you can't see it. A Black family is looking to sell their home in a predominantly white neighborhood, and they received an appraisal of $330,000. After removing family photos and other indicators of race, the second appraisal came in at $465,000. This is because an appraiser is coming into the house and they see a Black family and they already have that bias or assumption that, well, it can't be worth as much as a white family's home. And I have an actual instance with an ABC review by Diane Sawyer of a family that had the problem. So the people explained that there's an emotional cost to erasing themselves. Why should I have to take my Blackness out of my home to be treated fairly? And so in light of reports of homeowners receiving higher appraisals after hiding the fact that they're Black, homeowners of color wonder if they should remove evidence of themselves from their homes before getting any type done with their house. And that's especially an appraisal. And erasing their identity is time consuming. It has long-term emotional effects, and the woundings associated with it don't go away even after the exercise is done. It's really tragic that it is. So I had a quote here, and I'm sorry you can't see it, but maybe we can talk about it. Matthew 25:40 says, I'll read it. And the king will say to them in reply, and then I say to you, whatever you did for one of these least brothers of mine, you did for me. But let's turn that around just a little bit. And Richard Rohr does this as a Franciscan out in New Mexico. He says, what about if you say to this quote, and then I say to you, whatever you did to one of these least brothers of mine, you did to me. And that kind of changes the tone of equity around a little bit. It's something that you can do something for somebody, but if you do something to somebody, or you're doing the same thing to Jesus. And he says to them, and then I say to you, what you did not do for one of these least ones, you did not do for me. So that's something that to be thought about, if rather than for, but two. So it holds the same effect, maybe a little bit more of a burden. So it's something to think about. And at times, do we spot bias or aware of any bias? It's talked about all the time. And as individuals and members of a faith community, what can we or should we do to recognize bias, and how can we be on the guard or on alert for it? And again, it's we see articles and write-ups on implicit bias. It's just that when something's different, do we think differently? And that's something we have to be aware of. But And that's pretty much it. I have a closing prayer and a little quote that I brought up with. So I'll say that now too, so we can have a discussion if we want. This is by Patrick St. Jean, a Jesuit, and he's the author of the spiritual work of racial justice, a month of meditations with Ignatius of Loyola. And the prayer goes like this. Blessed are you who ask your bishop about racial equity training and programming in your diocese. Blessed are you who are willing to engage in a sincere conversation about race. Blessed are you who embrace your Black sisters and brothers in the fight for social justice. Blessed are you who are willing to be uncomfortable for the sake of healing our society. Amen. And one final word, and this is something that drives me on too. It's Lent is a time for prayer, fasting, and almsgiving. Well, let's remember, advocacy is a form of almsgiving. That's by a Franciscan sister, Sister Maria Lucy. So with that, I'm ending it. I apologize for the lack of slides. The video was pretty convincing and striking, that having somebody have to remove their Blackness from their home, and they gave a lot of examples with it also. So that's the end of my presentation. We can discuss things, have questions. It's amazing over the years that we've had the experience, and I work with 3 civil rights lawyers in the office who have filed cases, and quietly they put forth actions all the time, and they're frustrated a lot of times too by some of the things that go on. But they plot ahead. They do their work. They do due diligence. They work their cases, and they send it forward. And if something happens, maybe something doesn't happen right away, but those cases eventually will go to trial if they can get buy-in from the administration. And this administration says, yeah, those cases are going to go forward. So that's pretty much the end of what I was going to do.
Good.
Okay.
Thank you very much.
Thanks for listening. Wasn't too confusing. It's just wanted to lay some groundwork for the disparities.
Yeah, thank you. Now that's really very, very good. I just want to say a couple of things. Can you send me both of those prayers? Because it would be great to put those on the website.
I will. Yeah, sure.
The link for the video, you could either send that to me or put it in the chat, because then we could all look at that, but you would have to copy it and paste it and put it in the chat. But if it's easier, you can send it to me after the fact, and then folks can just look at that afterwards. But I don't know if anybody has any questions for Dave on this.
Dave, I have a question, actually. Thank you so much for the presentation. So in the when you're talking about sort of the predatory lending and the subprime mortgage, my understanding of that period is that a lot of that fell really heavily on the poor, like people who were unsophisticated. So I was actually kind of curious, what happened in like the poor white communities? Was it the same? Was it the same?
They lost their homes too, and they were tragically and they were taken advantage of, and the interest rates started to creep up, and they did the same thing. They said, well, California was really hit bad, because I'm assuming I know I can make more money next year, and that extra income never did come. And poor white communities. And about 15 years ago, the State Housing Finance Agency in Pennsylvania anyway said, how about you let us put a curriculum together for financial literacy in high schools? And 15 to 20 years ago. And I'm saying that because I just heard it again on the news, that wouldn't it be a nice idea if we put financial literacy in high school curriculums? And back then it was teaching to the test, and they said there's no room for it. We're not going to do it, and you can't even come in on an in-service day or anything like that on a ad hoc basis. it's excluded it. But now they're saying now we need it, and folks who have a little bit of knowledge at the front end, it's important. And this is something that hardly anybody does. One little thing is when you buy a car, you might go to 2 car dealers and get some pricing to say which one's the better price. I hardly ever do that with a mortgage. You say, okay, what kind of rate can you get for me, and how good a rate is it? When they know you're going to another quote, believe it or not, those terms loosen up a little bit. It's by getting, I'm going to check somebody else too, and you're moving forward so fast with real estate transactions these days because of the way the supply of homes are, and if you trust the person you have and they you know them, they go to a good institution, you're going to go with them. But I always tell folks, if you're not really sure, go for 2 different sources. And I've seen story after story. I can tell you where by the first source comes down a notch to meet the terms of the second one, just because they went somewhere else. It's shopping.
And my second question is, are realtors helpful, or are they part of the problem too? Like, I'm wondering if, are they protecting their clients to say, look, this doesn't look right to me? I mean, they have so much experience. I know sometimes they're all connected, the lender, the whatever,
Yeah.
but I mean,
You would hope.
What's the realtor's role in this?
Realtor's role is to at least do some preliminary analysis, but they usually have somebody at a mortgage company will do a pre-qualification. I just recently talked with somebody who's buying a house, and I said, well, there are HUD-approved housing counselors out there that don't charge you, maybe a couple of dollars for a credit report, and they will do a lot of that lot for you. And right now in Pennsylvania, you can get up to $16,000 in closing cost assistance by going to housing counseling, and they'll actually do the initial analysis and help you through it. But realtors will push you probably to a mortgage person who has to do that. But the initial inclination is for a realtor telling a borrower, what you're telling me, you can't afford to buy this house, look for something else. Let's try to do that. Will they tell that to a client? I don't know. You would hope that they do, that they're honest. And I know realtors I know try to be diligent when they're working with borrowers, and they will tell somebody, you're not going to be able to buy this house now, but you work on it for the next 6 months to clean up your credit. It depends on the individuals and how driven the business is. For the most part, they're good people, and they're supposed to do initial analysis, but really they're not really that skilled in the whole financial review process. Good questions, though.
Yeah. Any other questions? I just had one question. If you could say, Dave, just briefly, you were talking about the Federal Reserve Bank at the very beginning, and you had emailed me programs that the Federal Reserve Bank was doing, which really were starting to get towards equity in lending and things. Can you just comment on your experience of going to those webinars?
Oh yeah, I think they have one more to go. I haven't seen the schedule yet, but there's a series of 12, racism in the economy. And they got beat up in the press really bad, the financial press. What's the Fed Reserve doing with dealing with racism and social issues? But they realized that if you take this particular money out of a particular population and keep them from building wealth, you hurt the economy in the long run. So they went through housing and employment and career statuses, a number of different things, and I think they've had 11 different programs so far, and they're all available on the Federal Reserve's website. You can actually view those through a YouTube link, and they realize that that there isn't equity. And one thing I didn't mention, I have it here again. The Federal Reserve sees that something needs to be done, and so they're still doing it. And they're going out there and saying, no, everybody does better if we all do better. And people, communities of color, even low-income communities, they need to be brought along. And if they can build wealth, then everybody does better. Just recently, a friend of mine forwarded this to me. The Department of Treasury now, separate from the Federal Reserve, just decided, they announced on March 4th, there's a Treasury Advisory Committee on Racial Equity and Financing. And they're looking for people to sit on it. It's a 25-member advisory board. If you know anybody in Villanova might be interested, that's anybody that they're looking for nominees or people themselves nominate. And they're putting this together because they realize that there has to be some type of there is inequity, and it's racial inequity in the financing system. And the Treasury says this is coming to a higher level now. It's starting to bubble up, and like the appraisal issue, it's really the appraisal issue is right down. It's see Casey, but it's really something that's starting to come up, and I know why the state's not giving me this information, because it's a hot potato. And I asked her for a status. I haven't gotten an answer back yet, and I'm not vicious or anything like that. I don't want to just go right to the newspaper or the press and say, look what they didn't do. And the press already knows this. But at the same time, I'm an individual, a Pennsylvania resident who asked for this under the right to know law. I'm just going to raise it up through the system to say, okay, why are you not complying? And we'll see what happens. So
Yeah.
To be determined and to be announced. So.
All right. Any other questions?
Okay,
All
well, I will definitely get that video. It's a good one. Diane Sawyer does the interviews.
We'll follow up with a couple of things, the two prayers, because it's
For
nice to
sure.
see them in print too. And then that video link that you were talking about, and then also that information from the Treasury that you're saying, and even the link for the Federal Reserve Racism and the
Oh,
Economy
sure.
was available. for
Together.
folks, too.
Okay, real good.
Yeah, that would be
Okay,
great. Well, thank you very much. Thank you, everybody.
thanks for bearing with me.
We'll have a program in May, no program in April, because Interfaith Hospitality Network is having their 30th anniversary on the 4th Tuesday. So on the 26th, over at our Mother of Good Counsel. So it's the 30th anniversary celebration and marking the beginning of that organization, and how the first family who didn't have housing, actually really fitting, stayed at our Mother of Good Counsel parish in Bryn Mawr. So that's why so then we'll be back again in May for our May program. That'll be Bill Yo.
Okay,
Great.
thank you all very much.
Thank you,
Appreciate it.
everybody.
Have a good night, everybody.
Thanks.
Thank
Yeah,
you.
thank you,
Take care.
everyone. See you soon.